Welcome back. PSG Financial Services posted an 11% increase in annual recurring headline earnings per share. This was achieved against a backdrop of challenging operating conditions. Group CFO Mike Smith joins us now to paint a clearer picture of PSG's full-year performance. Thank you so much for your time, Mike. You experienced double-digit growth in your key financial metrics. Is this a continuation of solid momentum?
Yes, thank you. Particularly considering the challenging economic environment and that, we're pleased with the growth. If I look at our wealth division, which is our largest division, contributed 64% of our earnings. In that division, they accumulated 19.6 billion of positive net client flows, and we also had a 30 billion rand positive market performance. So that was providing good investment outcomes for those clients, and that division was up 17% their earnings. If I look at the last 5 years, that division has actually accumulated just under 80 billion of positive net flows over the past 5 years. So I think, good long-term track record there. If we look at the asset management division, their earnings were similar to the previous year. The main reason for that is just lower performance fees, but we had an increase in recurring management fees, and we picked up 3.5 billion of positive net flows. And then our insured division was impacted by 3 catastrophe events during the period. We had the floods in the Western Cape twice, as well as hailstorms in Gauteng, which meant the underwriting margin in that business declined from 13% the previous year to 9.7%. But what I'm really pleased with is the top line growth that we've achieved in all of the businesses during that period. And we've continued to invest for the long term, both in people, infrastructure and systems and that. So I believe that we're well set up to continue to achieve good growth. Also, when you look at our relative small market shares that we have in each of our divisions.
All right. Mike, you mentioned the PSG insurer being impacted by the floods there. And I'm wondering, if at this point you are not comfortable, but in terms of how it's filtering through to your numbers, you are comfortable with those numbers, or do you think that there could be some sort of risk adjustments made there, considering obviously, the weather events that have been happening concerning climate change?
Yeah, so look, I think it's both climate change as well as a degradation of the infrastructure has a negative impact on the business. And I think that's where the skilled advisors who can understand the risks, and we've also the quality of our actuaries and underwriters that carefully evaluate that. We also have good reinsurance programs in place. But there's been a number of climate events globally as well. So one's seen the cost of obtaining these reinsurance cover going up. But I think clients have also realized the importance of having cover because of all of these different type of events. So I think it emphasized the importance of insurance cover, but it has increased the cost as well.
All right. Well, talking about other things that are out of your control, and that's, of course, equity market activity. I'm wondering how that filtered through to your numbers, and also what story it's telling in terms of trading activity.
Yeah. So if you look at the JSE, from February to February, that market was down 6%. So that had a negative influence. Look, cash and bonds were up about 8%. If you look at the S&P 500, in rand terms, was up 34% during that period, 5% because of currency devaluation, and the rest because of performance, particularly on the technology sectors. But our clients are well diversified across different asset classes, locally and globally. So that's why we've been able to deliver good investment outcomes for those clients, despite having the level of volatility we've experienced.
All right. I do understand that there are, additional costs that you are shouldering on in terms of reinvesting back into the business. Would you say that even with those costs, those additional costs, that your margins are fairly protected at this point?
Yes, so I think, yeah, I mean, over the long term, we've actually seen, yeah, an increase in our margins as well. So, yeah, I think just because we've been able to grow the top line well over various periods. So, I mean, overall top line revenue growth has been greater than the increase in costs that we've incurred.
All right. I mean, just to wrap up the conversation and really touching on the outlook there, Mike, what is PSG Financial Services capitalizing on to continue this momentum in the short to medium term? But also, what can shareholders look forward to in terms of returns and also value unlock?
Yeah. So if you look at our return on equity is 23.4%. We've provided very good returns for shareholders over a long period of time. I mean, if you look at our total return index, where you look at the share price plus the dividend, if you had put 100,000 in PSG Financial Services 19 years ago when we started trading, would have grown to just under 8 million rand. Where if you put the 100,000 in the JSE, it would have been about 970,000. So more than an 8 times multiple. And if I look at particularly even in the last year, yeah, we've achieved share price growth plus dividends and provided good returns for shareholders, especially on a risk-adjusted basis over a long period of time. So I think, yeah, a lot of positive momentum that we've got in the business. Yeah, and I think, yeah, with the new talent that we keep bringing into the business and people with a can-do problem-solving mindset, you end up finding opportunities even when times are tough.
All right. Well, thank you so much for your time. Just highlighting, the story that PSG reported there in those results for the year that was, and also what we can look forward to. That was CFO of PSG Financial Services, Mike Smith.